Good morning, good afternoon, and good evening. Wherever you're watching us from, thanks for tuning in. I'm Dan DeFrancesco, lead writer for the BI Today newsletter. So prediction markets have exploded onto the scene in recent years, from sports to politics to weather. Everyday investors have jumped at the chance to make bets on just about anything. And now Kalshi sees an opportunity to get institutional investors and companies onto its platform. Today we've got the man responsible for building out that business, Andy Roche, Kalshi's head of institutional, joined the company this year after a long career on Wall Street. Andy, thanks so much for joining us today.
Thank you for having me. Great to be here.
Of course. So we got a ton of questions we can get into, but before we get into that, just a quick reminder, we'd love to hear from you. Drop your questions, your comments in the chat, and we'll be sure to address them in the convo. So to start, Andy, you guys are doing great in the retail space, right? Spring, you raised $1 billion. World Cup, massive boon for you. You're the biggest player in the US market for prediction markets. Now you're going after Wall Street. So who are you targeting? Because that's obviously a very different market and demographic than the retail folks that you've been so successful going after.
Well, I think, first of all, I guess there are a couple of things. So first of all, there's a huge amount of quality data that comes out of prediction markets. Sure. The users in those markets, we don't generate the data, but the users, the buyers and the sellers predicting yes or no in these markets, give a huge amount of information. That is valuable as alpha to pretty much everybody on the street. So first of all, it's like we've got a great quality data, give that to people. And then secondly, we've got people using it to trade, hedging. And we do that through a variety of ways. Firstly, just trade on the market. But secondly, what Kalshi does is work with people to say, what's the market that you want? What's the risk that you have? What's the problem that you're trying to solve? And let's build a market for you. Let's build a market that will help you make better decisions. Let's give you better data to make better decisions. And so to start with, it's a data product. Secondly, it's like a trading product around that. And then, so that's where we are.
So when you talk about institutions, I know, there was an example earlier this year, a bar was running a Knicks promo, hedged itself, right, which was really interesting. And then just this week, story about an ice cream shop that hedged itself with the weather, which also, side note, I don't know about with you, I don't care what the temperature is, I'm eating ice cream.
Yeah, me too. I love ice cream.
Yeah.
Look at mine, I've got a dad bod for eating ice cream.
I mean, the ice cream, the people that also, I don't do iced coffee during the winter, I don't get it. Weather does not temper my menu. But so those are really interesting examples, but obviously those, with all due respect to them, a little bit small potatoes, right? Is that when you talk about institutions, is it as low as that, and how big does it get, or what do you view as the target when you're talking about this push into institutional firms?
So I think there's a few things there, right? So to start with, think about the development of the futures market. Think back to Chicago. Think about even back to Netherlands, and it was being formed, right? It's to allow individual traders to hedge their risk, and that's where it started. And then we've got a huge amount of liquidity now and a huge amount of standardization, which is great. It generates product, and it generates risk, and it generates a lot of volume. Take the ags market. We don't have very much in the ags market, but it's a really interesting topic. There are about 30 products that really trade in futures sense on the ags market. But there are hundreds, even probably thousands of individual products that exist. So you need to be able to think about what are all of those use cases. And so what the prediction markets do is, because they're very simple products, because they're funded products, because they're a simple, you and me agree, you think it's 50% likelihood, I think it's 50% likelihood, we both put those 50% into an account that gets locked up in CFTC money. It's very low risk, it's very easy to generate a new product, so we can evolve and iterate new products quickly. So given all of that kind of structured stuff, yeah, sure. Little hedges that allow people to do sponsorships, whether it hedges that allow people to do promotions, sure, that's really interesting and useful. Absolutely part of any footprint, and useful for society, useful for America Inc., for their corporations to be able to hedge things that previously they weren't. Being able to hedge makes your business better, makes you can take more risk. It means you can run your business better. But clearly that's not where the only place we want to be. And so we have some really interesting products. We developed a product recently, which was a market for an environmental hedge fund in California to do with solar tax rebates. And that ended up trading $600,000-$700,000, mainly in a block market. But that was a perfect hedge for a perfect situation for those people on that market. And so we generated real risk transfer. That's not small, given the gamma associated with that is pretty big. The payoff function's large. That any trade that you're ending up making $600,000-$700,000 from, or losing $600,000 or $700,000 from, it's a pretty big pretty big trade.
Yeah.
And we don't have a lot of leverage in that, but the gamma makes that pretty big. And the way I would think about that, if you were think about that from a notional perspective, you might want to times that by 20 to think about that from how much risk you would trade on some sort of normal future or whatever. So they're pretty big trades, and we're just at the early stages of seeing that development of those markets.
Yeah. So the way you broke it down, I want to get back to the data aspect because I think that's fascinating as well. But the way you break it down, you kind of have these contracts that you guys are consistently rolling out. Like recently, there was one about clinical trial pilots, right? And basically, the idea is instead of having to bet on or make a assessment on a company, you can just make an assessment on a specific trial that they're doing, and there's a yes/no answer there. And then on the other hand, you have like the example you gave with the block trade, a more bespoke, a more customized.
Yep.
Is it fair to say that maybe the customized is what you view as the path for Kalshi for the bigger fish, and the more the other contracts are more for like the everyday mom and pop shops or the SMBs that kind of want to get in and hedge themselves a little bit? Or do you see it as kind of either or?
I almost see it the other way around. I think
interesting.
I think that the reality is that to be successful in institutional, you need a variety of things.
Yeah.
So you need to get your data out to people. You need to have technology providers so that people can use the same kit that they're already using to trade. You need clearing brokers to be available to manage the risk onto the market. So there's a lot of bits and pieces that you need to go through before people can trade. And those are definitely things that we're being super successful actually in crunching through and getting people to connect to. But as you get those through, it means the number of people who can participate on the market, the number of people who can trade on the market just goes up and up. The amount of risk transfer that can occur on the market goes up and up. And so I think that the design structure is for individual small companies to be able to get onto the market, and big companies, hedge funds, asset managers, banks to be able to trade that as well. Sometimes they'll be trading the same product, maybe payrolls, maybe an inflation product, because that's a risk that they have. But maybe it's whether it's a product that someone wants to trade in an ice cream shop in Florida. Maybe someone else wants to trade weather because they've got a hurricane insurance that they want to manage the risk of in Florida.
Right.
And so all of those can trade the same contract in the same space, and it's up to us to broaden the universe of people who can get into that market, not just individuals, but all of the corporates, the hedge funds, the asset managers, etc., that can do that.
Right. What do you feel this is ultimately disrupting? Because you touched on a couple things there, right? We're talking about banks that traditionally a company will come to them and say, I have this business, I need to protect this. And you also mentioned kind of the insurance aspect. You might go out and buy insurance. Where do you see this offering? And as you push into the institutional market, what's the area of business that you feel like is really disrupting, that you feel like Kalshi is coming in and trying to compete with?
So I think, firstly, the ability to trade on an individual event is something that didn't exist really before, sort of prediction markets and especially Kalshi. So if you were like, I'm from the UK, you might have picked that up in my accent, but we had this thing called Brexit where we voted to leave voted to leave the European Union. And the reality of that was that two things were, first of all, it was like, it's not going to happen. And the second thing was, if you're worried about it's going to happen, you need to short the stock market. And what happened is, one, the UK voted to leave, and two, the stock market went up rather than went down. Right? So it's like the hedge was wrong and the prediction was wrong. Prediction markets give you an ability to trade that actual event. And that, I think, is just so useful for society. And so I don't think necessarily it competes with anybody because you've got this way of expressing risk. Now, sure, let's take an example. You might think that the payrolls number is going to come in really spicy and hot. And payrolls drives a lot of things. It drives FX, it drives front end of the interest rate curve shape. Sure, so people might be worried about that, and at the moment they might be going in and saying, right, I'm just going to do some hedging here, or I'm going to take some FX option exposure on. Sure, you might find there's a little less of that because people come in and lift a large block in trading a payrolls number to get their payoff, to their risk management of their position instead. But fundamentally, I don't think it competes with that. I think it's just an added source. So one of the examples Kalshi have is what we call KPI markets. So, take Tesla, how many cars, is self-driving regulation going to be passed? Will Mr. Musk remain as CEO and chairman? Those are kind of atomization of the risk. I don't think that necessarily competes with an equity market, and I don't think it competes with an equity options market. It just adds another source of data, another way to express as an individual, as a company, whatever, your views on that market.
So when you go to pitch these clients and you try to get more of these players onto your platform, is it, you don't necessarily need to change your trading strategy or your risk management strategy at all? This is just in addition, or is it some ways it can supplant some of it, do you think?
I think threefold. One, you've got alpha generated out of the data, which I said at the front, which will help you, I think, with your trading strategy. So perhaps it's augmenting what you're doing. Two, I think that yes, you can use it to add risk management layers to your trading to allow you to manage tail risks, to manage risks that were previously unhedgeable, that you were taking a basis trade on, that you were thinking because, oh, I'm worried about payrolls, therefore I'm doing these 7 trades. You don't know that those 7 trades are actually about payrolls because A, you've got to make a prediction on payrolls, but then B, all of the underlying markets, which are on a sort of a second order, have got to behave in the way you think that they're going to behave.
Right.
Because it's fine to be right on payrolls, but if someone else says something else at the same time, like we're going to do tariffs or something, then everything could move. And actually your hedge is the underlying product, that you wanted vis-a-vis the payrolls number. And so I think it's additive. They're an additive for a risk management thing. I think that the perpetual products that we've launched, which are futures that don't expire, perpetual futures, I think they are somewhat competitive to futures products that, say, CME and ICE and others have, and who I would view as our competitors in that space. And I think, there could be a view of some cannibalization of that, but that's not to say that perpetuals are better than futures, and it's not to say that futures are better than perpetuals. What it's to say is that those products can be really good for risk transfer if you don't want to have to roll it every month or every quarter.
Sure.
And so I think there are some scenarios where things we've done at Kalshi can be cannibalistic, if you will. But in general, I think we're adding a richness of data, a richness of trading opportunity to institutions. And frankly, what's super interesting is that institutions are coming to us. I've got a call later on with a very large institution.
You want to say who?
No, but thank you.
Just in case.
Thank you. And we are designing a product or a series of products for them specifically that they want us to launch because they want to get the information value associated with their existing portfolio out of these markets that we're going to launch for them. And so I don't think that's cannibalistic. That's providing alpha signals to trading in legacy asset classes as well.
So they want they're going to go to you and they want you to create a market that then they're going to look at the data on how that market trades, and that's going to inform their decision. So it's not even the actual market you're creating isn't actually the hedge. It's who jumps in and starts betting on it, and then they're going to look at that, and that's going to assess another decision.
Trading on it, yeah. Let's not use the word bet. Derivative exchange.
Sure. So Roy in London has a question, which I think, or a statement. This institutional test is not whether prediction markets are interesting. It is whether they offer liquidity, reliable data, and risk controls that sit comfortably inside an existing trading stack.
Yeah.
That is much harder product than attracting retail volume. So I want to take a step back and I want to break down these. We can, like I said,
I think Roy's right, by the way. Very clever man.
Yes. So liquidity. Because the thing I wonder is, as you start to create these custom hedges, Kalshi does not take a position, right? No. It is just a platform.
It is CME or ICE or whatever, right. Just connecting buyers and sellers.
It's just connecting buyers and sellers. As you get more customized, everyone has an opinion on where LeBron James is going to go or who's going to win the World Cup, as we've seen, right? You get a lot of activity on that. But how do you navigate the liquidity problem when a specific company comes to you with a very specific hedge that they want to put on that? How do you get the liquidity on the other side when these, hopefully, if things go well for you, these are big trades that they want to put on?
So I'll take a step back and talk about data for a second. We measure the quality of the output of a prediction using something called a Brier score. It's a mathematical term. And the Brier score is a way of calibrating a model. And so let's say that something happens 6 times out of 10, and the model said it was going to happen 6 times out of 10, and that happens consistently. The Brier score would actually be 0 because the model is perfectly calibrated to actual events. If you take your iPhone out of your pocket, you look at your weather app, and that's probably got a meteorological model. It's probably got a Brier score like a day out of about 0.1, which means roughly, using English rather than complicated maths, means roughly that 90% of the time it's about 90% right. So what Kalshi does is say, right, okay, we've got all of these markets. If you take our markets, and we reran this calibration recently, if you take all of these markets and you look at markets that have traded over $50,000, so that's point one. 1 week, and we exclude sports markets and some of the culture, mention markets, because they tend to, not because for any other reason than they just don't trade like a long way out. They tend to trade a lot more near time.
Short term, yeah.
But if you look at those markets 1 week out, on any market that's sort of traded sort of 50 to 60,000, this Briar score calibration comes in at 0.07, which means that 1 week out, the predictive value of the data, Kalshi's right, 93% of the time it's 93% right. 1 week out. CPI, rates, those type of things. So first of all, that's huge. And why is it huge? One, because it's got a massive alpha generation value in data. But two, what that means is that the market makers who are around that product go, well, that data's accurate. That market's really well calibrated. So you've got liquidity on the screen. Sure, you have liquidity on the screen. Could there be more? Sure. Add more all the time as more people join. Sure. As more FCMs join, as more people have access. Sure. But at the same time, we've got people who are willing to do block trades over that calibrated market. I had a situation a couple of weeks ago, large hedge fund in the office said, I'd like to trade US CPI. This was going to happen in a couple of days. I said, but I don't think there's enough liquidity. I called up one of the market makers, I won't say which, and I said, right, I've got a hedge fund here, they want to do that. And they said, right, well, I'll make you $10 million of risk at the Kalshi price. I'll make you $25 million of risk one tick away from the Kalshi price. And if you want more than that, you need to give me a few minutes to assess the slippage. So the reality is there's liquidity on screen, but there's liquidity available off screen in blocks that is calibrated because these markets are so well calibrated to trade. And so I think our ability to both generate pricing and generate liquidity is actually really good and is on a really positive story.
So your position is that the market makers ultimately will be able to come in and offer that liquidity, because on the one hand, that's obviously what they do in the equities market and everywhere else. But on the other hand, those markets are deeper and they're able to get that risk off, right? Because they never really want to be long or short anything. They always want to be even and kind of exist in the middle. That feels like it'll be a little bit trickier as they start to take on more and more of these custom hedges.
Well, look, I don't want to speak for market makers, right? I'm a humble market practitioner. But I think their models are such that they can understand the multifactorial stuff. So I can, like, if I'm doing some payrolls number or some CPI number, I know how to hedge that in other instruments that exist in the market, and I'm comfortable enough that I can then get out of that risk. So I think they have so that would be my view on that. And I think that building liquidity takes time. And building liquidity requires all of that infrastructure to be in place, all of the connectivity, all of the pipes and plumbing to be in place. And we spend a lot of time just getting all of that, I wouldn't say dull, but important stuff done so that institutions can click a button and it's there, it's on the screen, the data, they can press a button and trade. That's how you build liquidity. That's how you build making and taking liquidity. And so I'm super confident about that trajectory, and I'm super confident that we can solve that. But not all markets are going to have infinite size of liquidity. And sometimes the liquidity is going to be more than you need. Sometimes it's going to be less than you need, and then it will trade in block market.
Do you have a timeline as far as when you'd like to, you guys a few weeks ago done the block trade, have done these others. Do you have a timeline on when you'd like to hit some of these goals as far as getting the more liquidity, and anything you could share on that front? Because I know your bosses have talked about potentially, or there's been reports about a 2027 IPO, and I know this is all a big part of the future growth. It was talked about a lot in the funding round. So where do you where do you give yourself as far as how quickly you want to grow that liquidity?
Look, the reality is we're growing at an enormous rate. I think it's really hard to pre-World Cup, I'd have said we were doing phenomenally well. I'd have said, look, the sports volume as a relative proportion of our volume is going down.
Bar changed a little bit now.
And then the World Cup was just phenomenally successful, right? And so the sports volume as a percentage went up. So, but it went up while everything else was also growing at the same time, right? So, I think we're. And measuring liquidity, what do we mean? Like, is it number of markets at the touch? Is it the depth of the touch? Is it the width of the market? So you've got different ways of measuring that, but we're super focused on understanding and measuring all of those. My sense is that there are a couple of things. One, we need to add some more FCMs because that, frankly, is the gateway to allowing other people. And I would say that, what would I say is...
FCMs being the people that are going to help facilitate all this type of trading.
Yeah, like if you're in the US, you need to get a broker often that sits between the clearinghouse and you as a customer, just either because that's your regulatory structure or that's because that's what you need to run your business. Operationally, you don't deal with that yourself. And so I think that we've got a whole series of non-bank brokers. I think the key thing for me is that, you know, what have I been saying to people? I'd say the binary assessment point, the thing that I would say, the prediction market, yes, we're being successful on institutional, is when we get bank FCMs joining. Get a bank FCM joining, then there's huge, you know, they're doing it because their clients want to. There's palpable demand around that.
Right.
That's the thing that I think is the key sort of trigger point that I'm looking at.
Interesting. Okay. So Steve in New York has a question about how will Kalshi ultimately distinguish its offering from competitors? And I want to take a step back because you have obviously the other prediction market types, but then also the folks that are already in this. We were talking before about, you know, a lot of this is what banks already do, right? And you know, that you go to your local bank, or not your local bank, you go to your big bank and you say, I have this business, I need to hedge it, and they write up a bunch of contracts and nobody sees anything and you pay a bunch of fees and then you hope that you're hedged. So I guess, what is it that you guys are doing that you feel like is really distinguished? Is it the speed? Is it the efficiency? Is it the cost? Is it the liquidity? I don't know. You tell me. What is setting Kalshi apart?
Well, I think I'm going to answer that question. Just go back to Steve's question. I'm going to answer that slightly differently.
Okay.
I think that, you know, what do I view as a competitor? I view like ICE and CME as my competitors. That's how I view that. And I think that when people talk about prediction markets, there's an awful lot said and written about prediction markets, but just to be clear, I think there's a huge difference between an onshore prediction market and an offshore prediction market. So the onshore market, we do full KYC. We know who the people are. You turn up, you have to give your name, you have to give your address, you have to say who you work for, right?
Sure.
Because ultimately, if you're doing clinical trials, you know, working for one of the pharma companies,
that would give you a little bit of an edge, I think.
Yeah. And so why do we do that? Because market integrity is super important. For instance, you know, we find people who we think are abusing the market because the data doesn't lie. We manage that data 24 hours a day, and we report people to the CFTC and the DOJ, and enforcement actions have come out of that.
Yes. Sorry, go ahead. I just want to step on it because I think that's something we haven't touched on yet, but I think that's an important piece of this puzzle, right? Is that, look, there is some narratives out there about, you know, people look at prediction markets and they say, oh, it's gambling, or oh, there's the insider trading, or there's this, it's a legal gray area. These are things that make Wall Street squeamish, right? It makes them nervous, like those type of narratives, not saying they're true or not true. I imagine that comes up a lot, or maybe you tell me, does it come up a lot when you're going around to the street and trying to get them on the platform, and how do you answer those questions or those concerns?
So yeah, and this, going back to Steve's question as well, I think, yes, it comes up a lot. And I have a fairly simple answer for that, right? If you want to try and do some market manipulation, insider trading on Kalshi, we will find you, we know where you are, and you'll go to jail.
It's like Taken. I will find you.
I'm like rocking my Liam.
Yeah, you are Liam Neeson. That was great. That was great. There's another guy you can sponsor. You know, get him on for the insider trading.
There we are. Maybe that's
that one's for free.
I'm going to take that one down. Okay, let's love that. But yeah, look, but I think that's there. So you have to have market integrity. And then, you know, when people give us cash in the market, that doesn't sit on Kalshi balance sheet. It doesn't sit in a tokenized deposit. It's like, it sits in cash, and that sits in a CFTC segregated account. That money's locked up. It's not on Kalshi's balance sheet.
Right.
And so we're using sort of the market infrastructure that you have, very analogous to CME or I. So you're using that consistent clearinghouse market infrastructure. You're using that. That's what matters. Exchange structure that's mattered. And then finally, you know, contracts. We talked about contracts. When we design contracts, they have to be designed precisely. They have to have fallbacks in them so that everybody who's trading them understands what the fallbacks are. One of the markets we have is a crypto market. It says, will crypto be higher or lower every 15 minutes? And what we do is we take from a benchmark provider 3 exchanges, effectively the traded prices for 3 exchanges for 1 minute. And then we add those together and we say that's what's going to be our benchmark price. Because I'm a futures guy. I don't like I don't like this concept that someone could bang the close on one market to move it for 1 second above a price to get paid off on Kalshi.
Yeah.
That would be market manipulation.
Sure.
So how we design our contracts, as well as all of the post stuff like checking people and looking at the data and reporting people, you've got to design the contracts correctly up front. And being inside the CFTC regulation is fantastic for that, because it's very clear, very specific. There are things you can and can't do. We also have our own rules and culture and how we want to skill for that. But that's the unique, I think, skill. That's the experience that you get with a regulated exchange like Kalshi.
Is that, you clearly put a lot of thought into that. Is this the toughest part of your job, you'd say, is when you make the pitch to Wall Street, navigating those conversations? Or is there something else that is a common question that comes up or a concern that's raised by these clients that you're trying to get on board?
Look, I would say the hardest part when talking to sort of big banks is, we've got 73 things going on, Andy. Love you like a brother, love this market, but we've got 700 people who are also doing innovative things, and we've got some crypto stuff that we're doing that's innovative, and we've got, we're changing this, and we're doing that, and we've got AI stuff, and so it's getting your spot in the priority list, getting your spot in that top 10 of things that you're going to do, and so that requires a lot of energy from everybody in the industry to become one of those things there.
Right.
And that's why I'm quite excited. I feel like we're doing really well at putting ourselves on that list of people care about this. People are connecting to it. People are wanting to get with it and trade it. And that feels like that's working. And then hedge funds and asset managers, as I say, it's about they're starting with give me the data. And I can't tell you the number of conversations that I've had, which is, give me the data, great, right, wow, that's amazing. Explain how I can trade now tomorrow, please.
That's like the taster, that's the teaser. You get them on the data, and then it's like, okay, there's something a little bit more here.
Yes, exactly.
So Matthew in New York has a question about kind of the use cases on it. So he says, as the macro markets moves are increasingly driven by policy, regulatory, and political shocks rather than traditional fundamental cycles. I think we can all agree that's definitely true. Are your institutional clients using Kalshi primarily as direct, asymmetric hedging tools for tail risk, or are they leveraging your implied probabilities as an alternative data signal to front-run repricing in traditional asset classes? So I know there's a lot to unpack there.
I would say both is the answer. So I think that the number of people who are yet trading tail risk hedges is low, but the number of people who are, like asking us to look at markets, developing markets, looking at that, because if something's got a 5% probability and it moves to a 10% probability, it's still a tail probability, but the chances of it happening have just doubled.
Right.
That's like, if I'm a risk manager or I'm a portfolio manager, I'm like, I think I want to look at that. What does that mean? If my correlations are breaking down, what does that mean? I need to be able to think about that and manage that. So certainly we see that from a data side, possibly a bit more than the trading side. But then I think we're starting to see people look at this as a way of diversifying their risk, as hedging tail risk, as providing insights. And if you're a macro guy, that's around the events we've just been talking about, politics, as well as payrolls and CPI and such events. But if you're an equity guy, maybe it's about some of those KPI things I was talking about, like whether regulation's going to be passed or whether a law's going to be passed. We have a market on whether the Genius Act is going to be passed, for instance, that people look at, because it's hugely impactful for stablecoins and bank revenues and such, right? Potentially. And so that gets looked at all the time as a tradable thing, and that's driving equity volumes and equity valuation. So is there a hedge there? Sure. Is the number of cars being delivered? Is the number of DoorDash deliveries made? Whatever. Those are all breakdowns of things that are happening in the real market, in the real world.
Right. I'm curious with ultimately the end goal. Do you view, and I know I'm talking to the man in the seat, but do you view this ultimately usurping the retail business? That this is where the real sweet spot is for Kalshi?
So I'm a relatively lone voice inside Kalshi, and I say the retail business I think is the frosting and the icing on the cake and the cherries, and that's fantastic. But I think that the institutional business is a really very tasty, very nice cake.
Sure.
And so I think there's a hugely foundational business. I've said this before. I joined Kalshi because I think this fundamentally is going to change market structure over the next 5 to 10 years. This is the biggest change in market structure, possibly even bigger than the changes after Dodd-Frank. This is the equivalent to me of electronification of markets. It's just generating a whole new world of asset classes and risks to hedge and manage, which will make society better because it can price more risks, and it will make traders better because they can evaluate on a number of different elements that they previously didn't have.
Right. Yeah, ultimately the possibilities are really endless here. It's kind of a choose your own adventure. The one thing I wanted to touch on real quick before I let you go, and Andy, this has been great. So obviously on the retail side, huge part of the business is sports. And we're also at the same time, you're pushing institutions. We're also seeing a lot of institutional involvement in sports ownership, right? You know, we just saw the Seattle Seahawks, Super Bowl champs, you know, get bought out by VC folks. Is that an opportunity? Because on the one hand, there's a lot of hedging that sports owners could do around their business. But on the other hand, it's a little bit, it's tricky. It's tricky. And I know there was something around the La Liga as far as them kind of putting in something around relegation because there's big revenue that comes with getting relegated or losing out on revenue. I guess, do you view that as an opportunity as far as institutions that you're targeting are also owning sports? Sports is a big part on your platform. Can there be some business there, or is that a little bit too shaky ground?
No, look, I think that one of the challenges is that we have a conversation about sports, but look, sports has got a phenomenal amount of money going through it. There's a huge amount of risk, and often that risk is managed in bespoke OTC contracts. I remember working somewhere previously where we hedged some of our risk regarding a sponsorship deal with somebody where we did a bespoke OTC contract. And I kept trying to think, how do we book this and how do we margin this thing, right? And so managing risks around sponsorship, managing risk around promotion. If you're a company and you want to take insurance on being relegated, sure, I actually think that's a really good thing. Now, where the governing bodies of those sporting organizations are, I would be not personally of the opinion that saying that's bad, because I think actually running those businesses and making those businesses better hedged is actually good for, in general. You don't want football clubs, you don't want baseball clubs blowing up because something's happened to them, right? So you want this, you know, the hedge, I think, is an appropriate risk management tool. But neither do you want to be able to say, right, I'm going to put a hedge on that I'm going to get relegated, and then you sell all your players.
Right. That's the concern.
So you've got to have. I think that the market has not got. You've got to understand what's going on. But let's just be clear: insurance has existed in this space for a long time. But the insurance premium, and maybe that's an example of someone who's going to lose out. Insurance brokers take a lot of premium out of those trades when they're arranging them. We're now producing a liquid price and a regulated exchange. That's perhaps the insurance process is more interesting because it's got nuances and. But the fundamental pricing point is now liquid on an exchange, and I think that's valuable for sponsors, corporate, treasurers, whatever.
Are those conversations you're having on with the league officials? Because they've shown obviously interest. I think just about every American sports league has some type of partnership with sports books. I understand very different business, not suggesting it's the same, but like they're clearly okay with some type of relationships as long as it's on their terms. Are those conversations you guys are having already, or considering exploring?
Those are not conversations that I'm having already, so let's put it like that. I think that I guess a couple of things, but one I'll say on sports is that the fact that Kalshi doesn't create prices, I think, is a fundamentally huge difference.
The market's setting it.
The market's setting the prices. So there's when somebody wins and somebody loses, I'm indifferent, right? I've just created the market.
Which is unlike the sports books, which end up having a position one way or another.
Correct, and that if you win, they lose, and if they win, you lose, and so I think that there's a lot of CME doesn't mind whether people are buying or selling U.S. Treasuries. They're just happy to ensure the liquidity is there.
Right.
And so I think Kalshi is indifferent to the price and indifferent therefore to the users and what they want to use on that market. And as long as it's sitting within the regulatory function, regulatory structures, that's really appropriate. But if we see or would see, and because we know who these various people are involved in the trade, see things that we don't like, as I've said, we know who's trading, we'll have investigations, we'll report them to regulators, et cetera, et cetera.
Last one here before we let you go from SNAS in Canada. you're talking a lot about the safeguards and stuff. They ask, what safeguards or transparency mechanisms do you find are most important or critical for institutionals to trust prediction markets? When you get in these meetings, what's the one that they often want you to point to, or the one that you point to that they maybe look a little bit more relieved in their seat?
Yeah. So I think that first of all, they like someone with grey hair turning up, right? So I think that's the first thing. The second thing is, we have a whole series of products, and so like sports is one product, politics is another product, economics is another product, companies is another, and so on and so forth. Weather, blah blah blah, crypto. And so what we have is controls within the exchange to say that you can have access to this section of the market, but not that section of the market. So if you're turning up and you're a fund manager and you want your people to have access to trade on economics and that, but you don't want them to have a view to be able to trade the fund on the World Cup, we've got those controls. So you can set up controls. The second thing we do is obviously all of the operational stuff about who can access the accounts, who can wire money in and out, the standard stuff all exchanges have. We have all of that type of thing, all exchanges and CCPs have. So I'd say those are the sort of key controls we spend a lot of time on. The last thing that I would say that is really interesting from our perspective is that we operate 24 hours a day, 7 days a week. And that's one of those questions that people go, oh, right, well, that's quite hard. And I get that that's quite hard because if you've been used to trading something that's trading, 9 to 5, 5 days a week, then it's different. But markets are trading 24 hours a day. Not always 7 days a week, but trading 24 hours a day. And having a sports background, having that sports pedigree meant that we've had to figure out, how do you move margin on a weekend? How do you transfer cash around at a weekend? How do you use stable coins? How do you use tokenized deposits? How do you use real-time payment rails? How do you use that market infrastructure that exists and make that institutional? And so we've done a lot of work on that. I would say that we're really good on that. And so let's take our perpetual product for a second. We run that 7 days a week, and we call margin both intraday and overnight at the weekend, and expect people to pay it at the weekend. So people, if they don't want that, have the infrastructure, sure, they can put a buffer up. But the reality is they're expected to pay that money at the weekend. And so we've calibrated our model where you actually move the money on a Saturday and a Sunday. And that's because we've designed that, we think, in a way that is the right market structure for risk management as we move to 24 hours, 7 day a week markets, because I think that people are going to trade, and certainly AI is going to trade 24 hours a day, 7 days a week. It doesn't need to sleep. And so that, I think, is the right market structure, but it's not necessarily the right structure for now. So to your question of what's the biggest thing, or one of the things I have to go through, is how do you talk people through how they manage risk of having to work at the weekend?
Yeah, I mean, who wants to work on the weekend? I do get that, but ultimately understanding that it's kind of necessary to really kind of exist in today's
I thought you didn't sleep. I thought you were 24-hour news, right?
Yeah. Well, I don't sleep because I got 2 little kids, but that's a whole nother story. I think that's a good place to leave it. Andy, this has been great. I really appreciate you taking the time.
Thank you for having me.
Thanks to all of you for tuning in. Until next time.